Informed Choice Radio, episode 232. So you're thinking about transferring your pension.
From Sundial House Studios in Cranley, welcome to Informed Choice Radio. This is the podcast all about achieving your financial goals in life. Here's your host, Martin Bamford.
Hello and welcome to the latest episode of Informed Choice Radio. Today on the podcast, I'm tackling the thorny and topical issue of defined benefit pension transfers. Some really big cash sums are out there on offer to members of final salary pension schemes, and now the regulator is taking an interest too. So I talk about the pros and cons of giving up guarantees in return for cash. Also on the show today, we've got a roundup of the latest personal finance news, my favourite money article this week, a random fact and an inspirational quote, as well, of course, as the aftershow segment where I share some of what we're up to here at Informed Choice this week. If you're new here, welcome to Informed Choice Radio. I'm Martin Bamford, your host for this podcast. I'm a chartered financial planner, chartered wealth manager, and personal finance author. This is a podcast from Informed Choice. We're an award-winning firm of chartered financial planners here in Cranley in Surrey. And at Informed Choice, we help you to achieve your financial goals in life and make those really important decisions with confidence. And that's what this podcast, Informed Choice Radio, is all about. You can find out more about the podcast. You can listen to our entire back catalogue of more than 230 episodes. And you can find the show notes for this episode, all of that at ICR232.co.uk. Before the main segment of the show this week, here's a roundup of the latest personal finance news. The government has unveiled its plans to ban fees paid to lettings agents in England. The Tenants Fees Bill was announced in the Queen's speech this week and could prevent the practice of tenants paying fees to lettings agents. According to the group that represents lettings agents, the new law could result in 4,000 job losses. Tenants currently pay average fees of £223 a year, with around 4.3 million households paying fees to lettings agents each year. Landlords will lose an estimated £300 million of revenue when the law is introduced, and this is likely to increase rents. A leading member of the Bank of England has indicated he will vote for an interest rate rise later this year. Bank of England Chief Economist Andy Haldane has said he might vote for a rate hike in the second half of 2017. He warned that leaving it too long to raise rates could risk steeper rate rises in the future. His comments caused pound sterling to rise briefly against the US dollar. It followed earlier comments from Bank of England Governor Mark Carney, who said now is not yet the time to begin rate rises. Interest rates were cut to 0.25% last August, following signs of an economic slowdown prompted by the Brexit vote. The Financial Conduct Authority has told insurers it should do more to help customers who have cancer. The comments follow a case in which a nurse with terminal breast cancer was quoted a premium of £2,800 for travel insurance when taking a holiday in Dubai. The FCA said that holidaymakers with cancer can sometimes find the cost of travel insurance higher than the actual cost of their holiday. A spokesperson said financial services need to be able to adapt to the changing circumstances that life throws at people, rather than being designed for the perfect consumer who never experiences difficulty. The British wealth gap has widened during the past decade. The Resolution Foundation, a think tank, has estimated that 1% of adults own 14% of assets in Britain. This means an estimated 488,000 people own around £11 trillion of wealth. At the other end of the wealth scale, 15% or 7.3 million people have no assets at all or are in debt. Responding to the report, the government said that income inequality is at its lowest level since the mid-1980s. According to the Resolution Foundation, the spread of property wealth in the mid-1990s and mid-2000s fueled a decade-long fall in wealth inequality, but this progress has since been reversed. Gross mortgage lending rose by an estimated 12% in May. The latest figures from the Council of Mortgage Lenders estimates that gross mortgage lending reached £20.1 billion in May. This is a 12% increase on both April last month and on May last year, in which £17.9 billion was advanced. The CML's buy-to-let forecast for 2017 and 2018 has been revised down from previous expectations at the end of last year, reflecting tax and prudential burdens in the housing and mortgage markets. The CML now expects buy-to-let lending of £35 million in 2017 and £33 billion in 2018, a decrease from £38 billion in each year forecast in December last year. Transfers out of defined benefit or final salary pensions are a really hot topic in the world of financial planning right now. With falling interest rates and gilt yields, the cash equivalent transfer value, the CETV, offered by defined benefit pension schemes has absolutely skyrocketed. I want to talk about transfers from final salary pensions today for a few different reasons. Firstly, there's been a big consultation paper published this week by our regulator, the Financial Conduct Authority, which is scrutinising how advice is given in relation to these pension transfers, and more on that in a moment. Also, earlier this week on Monday, more than 200 of my peers, fellow financial planners, met in Peterborough for a one-day conference specifically to discuss defined benefit pension transfers. I couldn't attend this one, sadly, as I already had some meetings in my diary, but I was following closely the debate on Twitter, and it raised several really interesting points. Around the same time, the financial press is reporting that the regulator might be actively investigating around 100 financial advisors due to their advice to individuals to transfer out of defined benefit pensions. We've already seen the FCA take some action on this front, and they've suspended the ability for a few firms to give advice or implement pension transfers, so there's clearly some big regulatory concerns about the suitability of advice. And we've also in the past few days seen some research from the insurer Royal London. So let's start with that, as it provides some really useful context for this particular subject. Their new research has identified the most common pension transfer value in the range of £250,000 to £500,000. So pension provider Royal London surveyed more than 800 financial advisors and discovered growth of more than 50% in the volume of transfers out of final salary pensions during the past year. And that's a huge rise in demand for financial advice on this subject. With a typical transfer value of more than £250,000, these pension transfers are often worth more than the average value of a UK home, which stood at about £216,000 in March. According to the survey, the majority of those choosing to transfer out of defined benefit pension schemes are in their 50s, and they've got a typical cash sum on offer between 25 and 30 times the annual guaranteed pension being given up. In some cases, the cash transfers are worth 30 to 40 times the annual pension, with 1 in 4 financial advisors reporting pension transfers in that particular range. So let's imagine for a moment that you were a member of a final salary pension and you had accumulated a deferred pension benefit of, say, £25,000 a year. The Royal London survey is saying that cash values of between 25 times and 40 times the annual pension are on offer. So that means a cash equivalent transfer value of anywhere from £625,000 up to £1 million. It's not hard to see why some people are having their heads turned by those sorts of figures, because they look like big numbers. They are big numbers, but it's really important to understand why they're big numbers and what you're giving up in return for that big number and what that big number can actually do for you. Now, I have to say that these cash transfer values don't look unrealistic to me in the particular economic environment we currently face. In fact, I've got a client file on my desk right now where the scheme administrator is offering a cash transfer value of £2 million to one of our clients. Now, we're in the process of determining whether he's better off taking the cash value or he's better off taking the guaranteed pension income for life, which is on offer. And the right answer is it's always down to individual circumstances and down to the scheme and down to what's on offer. But the right answer for him could be the way we have to look at all of the facts, all of the assumptions, and work out which one's best. So what is motivating people to take the transfer values rather than stay members of the pension scheme and receive a guaranteed pension income for the rest of their lives for as long as they live? According to the Royal London survey, the most common reason for giving up a defined benefit pension in return for a cash transfer value was the ability to provide more flexible pension income in retirement. 83% of the financial advisors they spoke to gave that as their main reason. 78% of financial advisors surveyed pointed to the large transfer values on offer, which in my opinion is a really bad reason, because the transfer values are only bigger at the moment because it costs more to secure the level of pension income on offer that you're giving up. So if it costs you more to provide the same level of pension, then the fact that the cash value on offer is much bigger shouldn't necessarily sway you away from keeping a guaranteed pension for life. Advisors reported motivations for transferring defined benefit pensions, including inheritance considerations, access to greater tax-free cash, and taking benefits earlier than those available from the defined benefit pension scheme. Royal London also asked advisors for the main reasons they recommended against a transfer, and that's really important too. Those reasons included concerns about losing the guaranteed income from a pension scheme. I'd say that's probably the number one reason out there. It also included the investment risk associated with the transfer value. That's important too, because if you move away from a defined benefit environment where there's a pension promise, an annual pension promise, to a money purchase pension environment, that money has to be invested or kept in cash. But either way, you're taking a risk with that money, that pot of money. And another reason for not transferring was the transfer value representing poor value. So all good, valid reasons for not transferring out of a defined benefit pension. Commenting on their findings, Royal London Director of Policy Steve Webb, who's been a guest on this podcast before, said, "It is clear that large and growing numbers of people are choosing to exchange the promise of a regular pension in retirement for a large cash lump sum. For some people, the value of their pension pot will be greater than the value of their home. This makes it all the more important for people to think very carefully before making a transfer and take full account of independent financial advice before making such an irrevocable decision." Okay then, my thoughts on this subject. Making the decision to transfer your defined benefit pension is something that should never be taken lightly. It's a regulatory requirement for savers, any saver with a cash equivalent transfer value exceeding £30,000 to obtain regulated professional advice before they can transfer their final salary pension to a pension pot. Now that rule can sometimes feel like a really frustrating barrier to getting your hands on your own money. But it's a really important safeguard. It's a safeguard to ensure that all of the factors that are out there are really carefully considered before making that irrevocable decision to give up some really valuable pension benefits. If you're considering a transfer away from your defined benefit pension scheme, make sure you seek independent and impartial financial advice from a specialist who has got relevant experience with that particular type of advice. Now, this is not something that all financial advisors, all independent financial advisors can do. You have to have a specialist advanced pensions qualification in order to be what's known as a pension transfer specialist. But as well as that qualification, which all of the advisors here at Informed Choice have got, I think it's so important that you've got experience, genuine real-life experience, working with these very complex types of pensions. So choose your financial advisor carefully. And another thing you need to be really careful you look for when you choose a financial advisor for advice on transferring from a defined benefit pension is how you pay for that. I think it's important that you're prepared to pay a fee for the advice, because it's particularly dangerous to work with an advisor who works on what's called a contingent charging basis. That means that they receive a higher fee if they recommend you transfer away from your defined benefit pension. And that higher fee is often expressed as a percentage of the transfer value. It can run into tens of thousands of pounds. And we've seen an example just this week where a financial advisor wanted to charge £1,000 for the report and recommendations in respect of a defined benefit pension, and then 4% of the transfer value. And when I tell you that 4% would have equated to a fee of £20,000, you can see there's a clear motivation, a clear swaying away from any impartiality to say, actually, it might be in your best interest to transfer away from a defined benefit pension, because if you do, I'm going to get paid £20,000. So look for an advisor that charges a fixed fee that is not dependent on what the outcome of your advice is. You pay the same fee regardless of whether they recommend you stay or you go, because that's the only way to remove that particular bias from the advice process. So in order to receive truly impartial advice, pay a project fee for advice with no additional fees charged if you decide to transfer. That approach could result in the advisor recommending that you stay put in your defined benefit pension scheme if that is the most suitable course of action. And if that is the case, the fee that you've paid them for advice out of your bank account is money well spent. It could have saved you from making a very expensive mistake with an extremely valuable pension benefit. So that's what's happening in terms of defined benefit pension transfers at the moment. I mentioned at the start of this segment that there was a consultation paper published earlier this week by the Financial Conduct Authority, the FCA, our regulator. In a paper named CP 17/16, Advising on Pension Transfers, The FCA is aiming to provide financial advisors with a framework which better enables them to give the right advice so that consumers can make better informed decisions. And when I read that, I got to the end of the paragraph and I really hoped they were going to say to help consumers make better informed choices, but better informed decisions is close enough. Within the summary of the paper, the FCA says the proposals set out in this consultation aim to reflect the current environment and the increased demand for pension transfer advice. Since the introduction of the pension freedoms in April 2015, consumers have more options available to access their pension savings. This has combined with more recent changes to the financial environment, leading to historically high levels of transfer values. So it's that combination of pension freedoms creating more options for people to choose from when they reach retirement with their pension pots, and also the economic factors which are resulting in historically high levels of pension transfer values. Those two factors combined is what's prompting the regulator to look more closely at how financial advisors are going out there delivering advice and making sure that it's suitable. Now, one of the proposals in this consultation paper is removing guidance that currently asks advisors to assume that defined benefit pension transfers are unsuitable. As things stand, that's our starting point as advisors. The FCA has got rules in place that says advisors must presume a pension transfer is unsuitable before they give advice. So my assumption, if you came to me for advice about transferring your defined benefit pension away, is that it would not be in your best interests. And very often, once the analysis has been completed and the advice is delivered, we conclude that it is not in your best interest to transfer away from a defined benefit pension. That's the starting point. In the new consultation paper CP 17/16, the FCA says it's going to look to change its guidance so that holding on to safeguarded benefits will likely be in the client's best interest, but no assumptions need to be made either way by the advisor. Now, that's a fairly big change in their stance, but it's important not to look at it in isolation because the change in approach is only being taken because of other proposals also made within their consultation paper. Also within the paper, the FCA has proposed that all advice on transferring from a defined benefit pension is based on a personal recommendation. Now, that's certainly already the case here at Informed Choice. Every recommendation we make on any particular area is based on a personal recommendation, but the FCA is proposing this rule because it's become aware that advice has become focused on the transfer value analysis output rather than making a rounded assessment of suitability. Now, when financial advisors consider whether to recommend a transfer out of a defined benefit pension, they use a software system called a transfer value analysis system, and that produces a report. Within that report is a figure, a quite important figure, called a critical yield. The critical yield is the growth rate that would be needed to match the benefits due from the defined benefit pension scheme at the normal scheme retirement age if the transfer value is transferred to an alternative personal pension. I don't think that a competent advisor would ever consider that critical yield figure in isolation. They would always want to consider it alongside the personal circumstances, the personal goals of the client. But it's become a bit of a blunt instrument for deciding whether or not a pension transfer is suitable. Within the consultation paper this week, there's a proposal to change the format for the transfer value analysis reports used by financial advisors. The FCA is saying that following pension freedoms, a new overarching requirement to undertake appropriate pension transfer analysis, which looks at all of the client's options, should be introduced. This, as a minimum, will need to assess clients' outgoings in relation to income needs, how the existing and receiving pension schemes will impact upon these, and a fair consideration of the death benefits. The FCA said advisors often focus, in some cases almost exclusively, on the transfer value analysis element rather than making a rounded assessment of suitability based on all the relevant factors. In the most concerning scenarios, the transfer value analysis is undertaken first without any knowledge of the client and then made to fit the client's circumstances. The FCA continued, in some firms, the TVAS, the Transfer Value Analysis System, is seen as no more than a box-ticking exercise to be completed for compliance reasons. They say, instead of determining the required rate of growth, firms must determine an appropriate discount rate to value the amount needed to reproduce the safeguarded benefits after appropriate charges. And finally, they conclude, this discount rate should be appropriate for each client based on their attitude to risk, irrespective of whether the proposed receiving scheme will involve flexi access drawdown or an annuity. So that's a fairly significant change to the approach that the regulator requires advisors to take. But I think it's generally positive. I think that it should help advisors understand that they have to see defined benefit transfers as a holistic subject, not something you can look at in isolation, but something you have to take into account all of the client's circumstances and goals to see whether or not it's a suitable piece of advice. In conclusion then, if you're thinking about transferring your pension, if you're thinking about giving up your guaranteed pension income for life in return for a cash sum transferred to a private pension pot, please take care with that decision. As the Royal London research shows, there is a huge amount at stake here, possibly more than the value of your home. As the FCA consultation paper and the action they're taking against firms show, it is an absolute minefield for advisors who need to get their advice absolutely right and make sure it's suitable. There are some bad eggs out there in terms of financial advisors who are giving unsuitable advice or just approaching it in the wrong way. The main things to watch out for: contingent charging, which I've already talked about. If your financial advisor stands to make more money, in some cases significantly more money, if they transfer your pension, they recommend you transfer your pension, they are probably not acting impartially or in your best interest. So watch out for contingent charging, pay a fixed fee. Also, if they are only giving you advice about the pension transfer itself and not what will happen to the underlying investment afterwards, then you need to really question why they're giving advice on that. Similarly, if they're talking about just the pension transfer and not about your holistic financial position, not about your lifetime cash flow, then really do take that advice very carefully and question the advisor. Is it really in my best interest to follow your advice? My favourite money article this week comes from Mr. Money Mustache with an article called "Great News, There's Another Recession Coming." I'll put a link to that article in the show notes for this episode so you can have a read. In the article, he points out the slowing state of the US economy before suggesting some fair weather finance steps. This is the stuff you should be doing before the economy enters another recession, so right now. And of course, we don't know when that recession will be, but markets do move in cycles, economies move in cycles, so it will come. As he pointed out, we're 4 years closer to a recession than we were 4 years ago. Some of the steps he recommends include raking in your big paycheck while it lasts and not blowing it on temporary luxuries, keeping your living footprint efficient. He says in expensive cities, this is a great time to rent and not a great time to spring for the sprawling home of your dreams on a big mortgage. And also eliminate any last shreds of consumer and student loan debt. So those are all good tips if you're facing a new recession coming along at some point. I think the UK position is just about as tenuous as the US position at the moment when it comes to the economy. So worth a read of that article. Do let me know what you think about the article. Link in the show notes. And if you spot any interesting money articles, please let me know so I can share them in a future episode of the podcast. Our random fact this week is about Jesse Livermore, an American investor and security analyst. Livermore was famed for making and losing several multi-million-dollar fortunes and short selling during the stock market crashes in 1907 and 1929. He led a life of brilliance and excess. He was surrounded by mistresses, scandals, money and bankruptcy. And he was a legendary trader who played big and made $100 million by shorting stocks during the crash of 1929. But by 1934, Livermore depleted the fortune he earned on that stock market crash just 5 years earlier. He declared a third bankruptcy, went through his second divorce, and then finally committed suicide in 1940. Our quote of the week this week also comes from Jesse Livermore, who once said of investing money, "Don't give me timing, give me time." I'd love to hear your thoughts about what we've covered today on the podcast. Do leave me a voicemail via our website, icradio.co.uk. You can email me at martin@icfp.co.uk, or you can get in touch on Twitter at Martin Bamford. I would love to hear from you. Please do get in touch. Let me know what you think. I'd love to hear your suggestions. If you enjoy listening to Informed Choice Radio, please do take a moment to leave us a review on iTunes. It just takes a minute. Visit icradio.co.uk/iTunes. That will take you straight to our page on the platform. There's the tab there you click which says ratings and reviews. Leave us a quick review there. Leave us a 5-star rating, please, and we'll read it out in a future episode. Our latest 5-star rating and review comes from Gry22 in the UK, who said, "Martin's content is delivered in a very professional and organised manner. I particularly enjoy the roundup of personal finance news and some of the guest speakers. Keep up the good work. Regards, Bemi." So thank you, Bemi, for your kind words and for your ongoing support of this podcast. That's all for this week. I hope it's been useful. Do stay tuned for the after show that's coming up right after the following music. It's where I talk about what we've been up to here at Informed Choice this week. So until next time, I'm Martin Bamford, and this is Informed Choice Radio. And remember, when it comes to your money, the more you know, the faster it can grow. Hello, welcome back. Welcome to the after show for Informed Choice Radio. It's episode 232. And as always, this is a bit of the episode where I talk about the other stuff. So it's a bit less formal and a bit less structured. So this week, what I've been up to, I've been surviving the heat wave. I don't cope particularly well in hot weather. I find it hard to sleep. I don't really enjoy sitting in a baking hot office as my office is. We're in an old 1920s building which has got very little ventilation other than windows. And when there's no air moving outside, there's very little air moving inside. So it has been like an oven in here this week. So trying to cool down on Tuesday evening, left work slightly early and joined Becky and the kids. We went to the Riverway near Godalming and we went for a bit of a swim in the river. I swam for about an hour. So we played around with the kids. Ryan, who is 6 and is now the world's biggest fan of wild swimming, had a nice swim with me in the middle of the river. And then when the kids and Becky got out and started walking back towards the car, I swam alongside them for a bit. So that was a good way to cool off. And I actually felt cool for the first time in about 4 days that evening. We're also this week having some more work done here at the Sundial House. You'll remember, if you're a regular listener, that we had a new roof and a wild natural living roof put on recently. So this week we've had a new internal door put in downstairs, and that's so we can move some desks around to create a bit more space. We've got another new team member joining us next month. Also this week I've had a new fence built in the office car park. The old fence was starting to fall down a bit, and we're trying to make it look nice out there because we've got our 23rd birthday barbecue next month. So also on Tuesday evening, after getting back from our wild swimming trip, I was outside in the office car park until about 10 o'clock at night painting the new fence. So working hard this week and trying to take advantage of the cooler evenings rather than the very hot days. Also this week, we welcomed Lily to the Informed Choice team. Lily joined Andy and Lizanne on Monday in the administration team, and I think is enjoying it. She came back on Tuesday, and she came back on Wednesday and Thursday, so that's always a good sign. This week, I've had committee meetings coming out my ears. So on Monday, I had committee meetings for Cranley in Bloom, which I chair, and the Cranley Christmas Lights event, which was a good meeting. I think that was the second hottest day of the year so far, and we were talking about Christmas, which is always nice. But we're making good progress there. We need to raise £18,000 this year to pay for all the lights and the entertainment and things for the village. But it is a really great event. It's a great event for local families too. So I look forward to helping to organise that. And then on Tuesday, I had a trustee meeting which I chaired for the Knoll Park Trust, which is making some great progress. We are finalising our constitution at the moment before we make an application to the Charities Commission. So fingers crossed, within a month or two, I should be chairman of a charity, which is really exciting. But really what I'm excited about there is delivering an incredible 60-acre public park to the benefit of the people in this village. It's been a long time coming. I've been involved in that project for more than 2 years now. And it's making some good progress now towards actually delivery of the parkland. I'm recording this episode on Thursday evening, quite late on Thursday evening. It's 9:30 now. And the reason for doing it so late is today we had inheritance tax seminars at the Cranley Arts Centre. That was this evening. They were really well attended. The first one was actually sold out, and across the two we had about 30 people come along. Shelley presented the first one, Victoria presented the second one, and they both did an excellent job presenting the subject, but also answering lots of really great questions from the people who came along, who had some fantastic questions about inheritance tax planning, how to mitigate it and what they need to do. I've got to say, I'm finding myself really up against it this week in terms of workload, answering emails, returning phone calls and things. And the main reason I think is Matt has now left. Matt left on Friday. He finished his 1 year internship. So I'm now juggling his role, all the stuff that he was doing for me, and also my own work. And that's until our new marketing assistant joins us in September. And I did promise soon I'll give you some more details on who that is and what that will involve. We've published a couple of new podcast interviews this week, which have been really well received. On Monday, it was a bit different. It was an interview with a lady called Danielle Marchant, who is the author of a book called Pause. Danielle's got a really interesting story. She was a high-flying executive coach all over Southeast Asia, and she burnt out. So her body just stopped, effectively. Her mind and body told her she was working too hard. She wasn't giving herself enough sort of rest and relaxation, and it just stopped. So she's written a fantastic book called Pause, and had a really lovely conversation with Danielle all the way down in her home in Cornwall earlier this week. So that was Monday's episode. And then on Wednesday, we published an interview with Andy Bell. Andy is the co-founder and CEO of the investment platform AJ Bell. He's author of a book called The DIY Investor. And Andy is a great guy. He's one of the most down-to-earth guys I know. Really interesting book and some thoughts on the place for DIY investment. And also we had a chat in that interview about his views on Brexit and what leaving the European Union will mean for financial services regulation. I've carried out a couple of podcast interviews so far this week, two actually, both on, I think they're both on Monday or Tuesday, I can't remember which it was now, maybe one on both. I've got 3 more to do on Friday, which I've not written questions for yet, so it's going to be a late night tonight. So earlier this week, and both these episodes will be available to listen to next week, next Monday and Wednesday. So I interviewed Paul Moore from Wellings Capital. Paul is the author of a book called The Perfect Investment, where he talks all about property investment. And also I interviewed Tom Nichols, Professor Tom Nichols, who is author of a fantastic book called The Death of Expertise. Really enjoyed both of those conversations. They should come out as really nice podcast interviews, which of course, because Matt has left, I have to edit and produce myself. So I've got to find some time tomorrow on Friday or over the weekend to do that too. I'm currently reading Inside the Nudge Unit, How Small Changes Can Make a Big Difference. That's by David Halpern. And earlier this week, I finished reading a book called Playing to Win, How Strategy Really Works. And that included some really useful information about business strategy, but I found it a bit dry. It was a bit too sort of like a business school textbook for my liking. But I'm enjoying Inside the Nudge Unit. I'm learning lots, as regular listeners will know, about behavioural science at the moment. So particularly good read there. Coming up then this weekend, on Saturday, it's the Cranley Lions Fun Day and Carnival. We've got a stall for Cranley in Bloom, and we've got a planted welly boot competition. Over the same weekend last year, so a year ago, I was trying to walk 100 kilometres from London to Brighton as part of a British Heart Foundation event, and I got caught in a torrential rainstorm probably about 20 miles into the walk, and then had to pull out at the halfway point. And I had the worst blisters I've ever had in my life. And I've had some bad blisters in my time from doing crazy long distance walks and marathons, ultra marathons and things. But that was a year ago, and I'm just fingers crossed that we don't have the same torrential rainstorm this weekend when we're at the Cranley Lions Fun Day and Carnival. So hopefully the weather will stay quite nice. Not too hot, but quite nice. So until next time, thank you for listening to Informed Choice Radio. Please do consider sharing this episode with a friend. And if you've not done so already, just press that subscribe button in whatever podcast app you listen to podcasts through. That'll make sure you never miss an episode. And plus, the more people who hit subscribe, the better it makes our stats look. And when it comes to podcasting, the download figures are everything. I watch them every day. We'll be back on Monday with episode 233. That features the interview with Paul Moore of Wellings Capital, all talking about his latest book, The Perfect Investment.